Okay. Well, what I'm trying to do in this paper is bring about a unification of two apparently conflicting approaches to post-Keynesian macroeconomics, because you have of course, the sectoral balance approach that's very common, of course, in Kansas City, and the approach which argues the sum of all sectoral balances is necessarily zero. With the work that I've been doing, where I'm arguing that effective demand, and thank you, Nathan, for suggesting the name change, is GDP plus change in debt. Now, to most people, it looks like the former implies there's an accounting error in the latter on double counting, because we say income is equal to expenditure, and therefore to say that expenditure is greater than income must involve double counting. But if that's true, I'm in good company, because Schumpeter and Minsky made exactly the same case. If you look in Schumpeter in the theory of economic development, he argues that what he calls total credit, which is complete total demand, is greater than if it were fully covered, by which he means demand emanating from selling goods and services, including labour. And Minsky, rather more fully, says that current spending plans under all sectors must be greater than current received income. So I'm not saying something which hasn't been said before. What I'm trying to do is prove it. So Minsky's reasoning in detail you'll find in the classic Can It Happen Again? And I do recommend reading that book, not Can It Happen Again, a reprise, but Can It Happen Again? So he starts from sectoral balances and then says that's the surplus of each sector is then the difference between his cash flows inflow and out, and you necessarily have the sum of all those as zero. But he said that's an ex post accounting identity. But what actually is happening is the sum of ex ante behaviours that might not necessarily be consistent ex ante. So for that to be made, for that to be consistency to be maintained, so you have expenditure equal to income over the full recording period, then the finance markets must be reconciling that ex ante and ex post difference. He says, therefore, for real aggregate demand to be increasing, it is necessary, not possible or feasible, necessary, that current spending plans be greater than current received income. He said, now for that to happen, it follows that some sectors must be financing part of their spending by issuing debt. Now for that to happen again, if you're going to have that without meaning offsetting reductions by what the spending of other units might be, by those that took on the debt, then you have to have that being financed by either an increase in velocity or by the creation of new money. So Minsky, right back in his original Can It Happen Again, was arguing that sectoral balances are consistent with spending being greater than received income, and that being necessarily tied up with endogenous money. So there's a necessary link between the three. If you accept endogenous money, then you have to accept that aggregate demand or effective demand is greater than income, where the difference is made up by the change in debt. Of course, that I think ties the whole of post-Keynesian macroeconomics together and distinctly separates it from the loanable funds fetish of neoclassical economics. So there's inextricable link between endogenous money and demand exceeding income. And the mathematical logic goes this way, and this is where I have to thank my colleague Matthias Rosselli, who dragged me into trying to prove this in his room in the Fields Institute when I thought it was going to be a waste of time, and I had to eat my words at the end of the proof. So we start by defining income as wages plus profits, and then break profits into distributed profits and retained earnings. Having done that, expenditure, what you spend your money on, is going to be either on consumer goods or capital goods. And there are going to be two sources of demand for consumer goods, workers and capitalist incomes, and change in debt. So if you look at what the change in debt for workers for financing consumption, that's borrowing. That can also be negative. So I can take account of the situation in which savings is occurring. And equally for capitalists borrowing for consumption, that can also be negative. So savings or going into further debt are both covered. On investment goods, two sources there, retained earnings or new debt. And I then look at borrowing by firms for investment, that can be negative as well. So you've got the potential for either increasing or decreasing debt depending upon the economic circumstances. Well, let's compare the two equations. There's expenditure. I now expand it out, and to save you going through the cancellations yourself, let's shuffle the terms around a bit and put the income terms first and change in debt later. If I then subtract income from that, I get a few obvious cancellations. So the gap between expenditure and income is the change in debt. And I'm sure that still sounds like double counting. I've been through this so many times trying to prove it to very intelligent, non-neoclassical people. And I think it's because of the confusion between ex ante and ex post, which still bedevils us today, even though we all talk about that distinction in Keynes. Conventional thinking, even by post-Keynesian economists, falls into that ex post trap, which is comparing recorded expenditure with recorded income. But of course, we live in a demand-determined economy, and expenditure precedes income. And that's what Keynes realised when he got involved in his debates after writing the general theory. Talking about Olin, he said that it may be that an investment decision requires a temporary demand for money before it is carried out. He said that has to be a technique to bridge that gap, and that's provided either by the new issue market or by banks issuing new debt. So Keynes was aware of this issue as well. Now, another source of the confusion is that there is a mathematical identity, not just equality, but identity between recorded income and recorded expenditure after the event. And the reason we fall for this and don't see it properly is because debt is a discontinuous injection into the continuous stream of income that's financing expenditure. And after it's been injected, then it becomes part of income. But it has to be injected first of all to generate that extra income. So the recorded levels end up being the same, expenditure and income, while ex ante they are different. So let's have a look at a picture here. And again, thank you to Matthias for this illustration. This is showing the flow of income and expenditure over time. That is income at time t, income ex ante. That is the change in debt at the same time, and that is expenditure at time t. Now, if you record it, you're working backwards. That's going to be recorded income at time t. They'll be equal to each other. So a mathematical distinction about the difference between discontinuous flows into continuous functions is what's confusing us here. Measured income is time looking backwards. When you're looking backwards, you're taking the limit of the function from time in advance backwards, and there's a discontinuity at the point of the injection of debt. That is going to be identical to expenditure at the same time. And that confusion between ex ante, ex post investment expenditure and income and ex ante is what's led to this confusion. So you can argue, as it does there, I hope I can use the pointer here, let's use this pointer, that expenditure at time t is going to be recorded income at time t as well, which will be actual income at time t plus the change in debt. So the discontinuity is what's been making it hard for us to get our heads around this. Income before the debt injection is less than expenditure and income after the injection. So if I define income at time t as working towards that discontinuity, so you're going through time, that's income before the debt injection. And that is necessarily less than expenditure at the time of the debt injection. Now, after when you record it, coming backwards and looking at it in an accounting sense rather than economic sense, measured income after the debt injection will be equal to expenditure. But expenditure at time t will be recorded income at time t, which will be original income at time t plus the change in debt. And when you take a look at it finally in words, it's what the English might call bleedingly obvious. Expenditure is equal to income before the debt injection plus the debt injection. That's all there is to it. Okay? So the two concepts are completely consistent. And I think we can now reconcile the sectoral balances with the approach that I take, where aggregate expenditure or aggregate effective demand is income plus the change in debt. So there's the ex ante situation. Expenditure, when you record it, will be equal to income at the same time plus the change in debt. Ex post, they're going to be identical. So sectoral balances and effective demand exceeding income are totally consistent, even though the recorded ones not only are equal, but must be equal. And again, here's something from a mathematician who knows we have to learn from mathematicians so much. We've taught mathematics so badly by economists. That's partly why we're so hobbled in developing an alternative to the neoclassical nonsense. If you have these flows being identical except at a discontinuity, then if you try to record those flows and work out what the aggregate is over that time period, effectively you're integrating those two functions, where they only differ at a finite number of discontinuities. And a rule of mathematics, and what's called Lebesgue integration, is that functions that differ only at finitely many points of discontinuities must have identical integrals. So all the results people show from sectoral balances and so on, where they're identical, it's a mathematical property of flows with discontinuous injections. So again, none of this is inconsistent with saying aggregate effective demand is income plus the change in debt. We can integrate the two approaches. And you can generalize it, of course. We have to include not just the GDP, the economic activity, we also need to include the asset markets, because money is spent not just buying goods and services, but also buying assets. So if you expand what expenditure now goes on, it goes in consumption goods, investment goods, and assets. And if I just consider capitalists being the only ones who speculate, just to simplify the notation, then they're going to use part of distributed profits to do that, and they're going to borrow money for speculation as well. So demand for assets will be partly profits used for speculation and partly the change in debt used for speculation. You get the same cancellations. The change in debt now includes the change of debt taken on for speculative purposes. And for government as well, if you bring in government money creation at the same time, expenditure is now net of government spending. That, of course, is the change in government debt. You do your cancellations and you get the expenditure as income plus the change in private debt plus government debt. So the two have to be included. And of course, they'll include the foreign sector inside, they'll get a negative for the change in foreign debt. So this is all a necessary consequence of endogenous money. The only way to avoid these conclusions is to accept loanable funds, which I don't think anybody in this room is going to jump at the option of. So if some expenditure is debt financed and that loan increases borrower power without reducing savers' spending power, then aggregate demand differs from income, and it, of course, as Minsky argued, normally exceed it in a growing economy. So the change in debt is an essential part of a macroeconomic analysis. And of course, it has to be tied up as well with looking at change in the level of government debt. Now, this is the reason why I was able to identify, I'm not the only one, obviously, in this room. I can't claim uniqueness. I certainly can in the neoclassical room, but not here. But that's the key factor that I looked at to say why I expected a crisis to come along. And you really get a much more powerful message than the neoclassicals can possibly muster when you include the role of change of private debt. Now, to explain what's going on, I did more mathematics. Income is going to come from wages and profits. Borrowing is a change in debt. With the two categories of supply, goods and services plus assets, Schumpeter's argument was that we mainly spend income on consumption. And change in debt is a major source, not the only, obviously, but a major source of investment. And Minsky adds in that it also finances Ponzi behaviour. So if you look at this relationship, you can say wages and profits largely go on consumption. Change on debt goes a bit on consumption and mainly on investment and net turnover of assets. Break net turnover of assets down. You can say that's equal to the price of assets plus the quantity multiplied by the turnover proportion in any particular year. So change in debt becomes a factor in the level of employment and output. You get a relationship with change in debt and the level of GDP. And debt acceleration will drive change in demand and also change in asset prices. So there's an acceleration term from debt turning up in the rate of change of asset prices, which basically says asset bubbles must burst because they're based upon accelerating levels of debt. Now you put all this together empirically, and if you look at the decline in income through this crisis, it's relatively mild. And it occurs a couple of years after the crisis began when the BNP shut down its funds because of the subprime market collapse. But if you add on top of that the change in debt, which is what the blue line is, GDP plus the change in debt, then it's much more obvious when the crisis began and how severe it was. Rather than going from a $14.5 trillion to a $14 trillion economy, America went from an $18.5 to an $11.5 trillion economy. That's why it was a depression. And then looking now at the correlations between the debt contribution to demand and unemployment. Correlation there is minus 0.92 over the last 20 years. Now, according to neoclassical theory, of course, it should have no role before you hit the liquidity trap. But that ain't reality. Blind Freddy, who of course can see much better than most neoclassical economists, can tell you by looking at that chart. Equally, when we take a look at what's happening with acceleration of debt, which is going to talk about the change in GDP, the deceleration of debt, going from positive acceleration to negative, in this crisis was about 10, in terms of the proportion of GDP, that acceleration of debt contributed is about 10% higher than the Great Depression. It was a more severe shock to the economy, endogenous shock, than the Great Depression. Correlation there, over 55 years, by the way, between a second order and a first order derivative of economic data is 0.76. You don't get correlations like that unless you've also got causation. And here we are looking at mortgages. What actually caused the house price bubble, the subprime bubble? Accelerating mortgage debt. Correlation over the last 20 years, 0.83, between the acceleration of mortgage debt and the change in house prices. And you're getting a recovery now because mortgage debt is accelerating, even though the level of debt is still falling. And I couldn't find good data for the relation between marginal debt in America and share prices, but this is the correlation of change in the Dow Jones on an annual basis to the annual acceleration of total debt. That's a reasonable correlation. I could find good data for Australia, and this blew my socks off. Correlation between accelerating margin loan debt and the change in the Australian stock market is 0.8. So we have to get our heads around the dynamics of debt, private debt, and it has to be done in a dynamic sense. And that's why I've had written the program called Minsky, which is being developed with an INET grant right now. There's a very early version which is downloadable, and what I'll do in the next session is give a presentation about how to use it to build a dynamic model. But to give you an idea of what can be done in this particular model, which I'll explain in the next session, I've combined Krugman's model of loanable funds with endogenous money. And I then can flick a switch and go from one to the other. And if you have loanable funds, a dramatic increase in the rate of lending has almost no impact upon GDP. You change it in the other, bang. Okay? Our world about endogenous money simply differs from the loanable funds by having the debts appear on the asset side of the banking sheet balance rather than the liability side. Now this program uses double entry bookkeeping, by the way. I've learnt my lesson on that front. You have to use double entry bookkeeping. So I'll be happy to show people how to use that in the next session. You can model multiple banks, private and public money creation, horizontal and vertical money, and physical production, and dynamic systems in general. And I've embedded a few examples in the presentation there. You can download it from my website, and if you want to come and help develop the program or debug it, there's a SourceForge site for those who are into development as well. So the two examples I've done there. This is my favourite with old Paul. You've got to sometimes thank neoclassicals, the innocence of babes, coming out and making a statement that we have to go blue in the face trying to convince other people that economists don't include debt, banks and money in their modelling. And a Nobel Prize winner writes precisely that in the New York Times. Thank you, Paul. I'm all for including the banking sector in stories where it's relevant, but why is it so crucial to a story about debt and leverage? And he then actually accurately characterises me. But here's the loanable funds argument. If I decide to cut back on my spending and stash the funds in a bank, which lend them out to somebody else, this doesn't have to represent a net increase in demand. And he says, well, Keynes saying something else, and he's quite accurate here. He didn't start to distort me until the second or third blog entry. Keynes is saying something for the notion of creating money equals creating demand. But again, that isn't right in any model I understand. Doesn't that say it all? Well, I easily put his model together. Patient lends to impatient. Transfer dollars from one person to another. Patient gets more spending, less spending power. Impatient gets more, no aggregate change, and banks are just intermediaries. That's easy to model in Minsky because all the action here is on the liabilities side of the banking ledger. So what you'd see in terms of double entry, but this is our approach, of course. Entrepreneur goes to the bank, or a Ponzi schemer, unfortunately, says, I've got a great idea, and the bank says, that's a great idea, here's $1 million. By the way, you owe us $1 million. So those are the two situations I'm now comparing by putting together into Minsky, because what you've got with the loanable funds is all the action is on the liabilities side of the banking ledger. There's no increase in the aggregate stock of money. But with ours, of course, there is a change on the asset side of the bank and the liability side, increasing liabilities in circulation, which increases the amount of money and also the level of income. So I model that together. I can now switch between one and the other and show that when what Paul's talking about is this section here, I start the model, and this is dynamic, by the way. I'll quickly bring it up and just and show it running. That's the model. Let's just reset it. If I start with Paul's idea about lending, and have a very conservative lender there. This is the lending up here, taking 77 years to lend all the money in his account. Then you get a tapering to an equilibrium level of money in the economy. GDP settles down after a while, no particular change. But if I now turn on endogenous money, then we get a growth in aggregate demand and a growth in the money supply. Go back to Paul's idea, and a dramatic change in the standards of lending have no real impact on the dynamics of that process. You can go from the patient person lending his money out in 1 year flat to taking a century to do it, and you don't change the trajectory all that much. But if you change what's happening on go back to the real banking model and change what the banks are doing, then if they slow down, the economy plunges. If they accelerate, the economy takes off, etc., etc. All easy to model, and the sort of thing you can even show to a Rotary Club if you wanted to. So let's go back over here. For reasons of time, I won't carry on to the next model, but what I've also done here is quickly include modelling both government and private money creation. So if I bring up that particular model, I have 3 tables, one to represent the bond assets of the Treasury. I found I couldn't do the amalgamated idea that's a standard MMT idea about consolidating. You really have to have 3 separate tables. One for the bond assets and liabilities of the Treasury, one for the central banks assets and liabilities, and one for the private banking sector. And you can also now, various other features I'll show about the program in the next session, but it's possible to bring MMT and MCT together, which is my ambition. Thank you. And now to Matthias.